And do we have good visual on my screen right now?
Yep, looks good.
Excellent. All right, guys. Well, we are replicating a very similar trade as we had from Monday. The short call has gone up a strike. Otherwise, it's the same. We were sitting on a pretty big gain overnight, and then we had the attack on Iran. The general was assassinated. We'll take a look at that, and especially our TLT position. But to start off, let's just review today's trade. We're selling the 324 January 6th, 324 call. We're buying the 320 put. And we're also purchasing the 325 call. You were so tempted for what yesterday, Karen? Okay, so that's today's trade, and it's already moving in our favor. When I entered the trade, the SPY was at 322.63. So you're going to show larger profits. Oh, on the TLT. Yeah, you're okay. I think you're going to see you'll be actually happy that you held on to it when we look at what we call the double payday on the inverted option caller. If that works out, it's actually how we can make the biggest gain because we allow ourselves to get out with a profit on the long side of the TLT and then end up just long our put. So if you are following our trade alert through the previous trade, you're going to have a larger profit than I did closing this out, but I'm already up on the new trade. So that's how that works out for you. Small time gap of about 30 minutes from when I post the trade and you post the trade. So this market's extremely bullish. Here's the reason why. Every Thursday, they release the H41, and this shows you the increase in the balance sheet. So I'll post this to the chat. If you guys want to bookmark it, you don't need to because you got me. But here's where you can go every Thursday after the market closes and read a nice little financial statement like this. And what we can see is they're massively buying the front end of the treasury, and they're letting mortgage-backed securities roll off as well as notes and bonds. So the net increase in the balance sheet may have only been $10 billion, but in terms of security purchases, it's much larger than that. In fact, you can see $164 billion was purchased on in the T-bills right here. So they're putting a tremendous amount of capital into the treasury market, and they're letting the middle and long end of the treasury float. So they're letting those bonds roll off. They're selling their mortgage-backed securities, and they are just going full force on that front end of the yield curve. From our point of view, if we look at this, this just updated this morning, you can see the incline slowed down a little bit week over week. This is not one of those rapid rising inclines as we've had for most of December, but it's still an incline. So they're still adding to the balance sheet. And what this means is you want to bet up on the SPY. It's just that simple, and down on the TLT. We'll take a look at that. Here's the results of our previous trade. Let me zoom in on that. Now, yesterday at the close, we were close to that 325 price where we had a long call. So if this had continued into the morning, who knows? We could have had a record SPY profit today, but we're still up 60 cents. And we did it while being extremely protected. So the SPY traded from 321.37 to 322.64. The options cost us about 60 cents to put on and another 8 cents to get out. So we got to keep 60 cents of the rise on the SPY, and we did so with extreme protection. So that's the goal, and mission accomplished on that front. GDX went up a little bit more today. It's up $1.02 after we pay off that expensive put. So it's a bummer giving up half your profits on the put, but remember, gold had been sliding on us for 3 months when we continued to be long gold. So we can start to take a little of the defensive measures off of GDX going into 2020 now that the markets are reacting to 100 billion plus per month of stimulus from the central bank. Emerging markets did pull back a little bit, but we're still up 40 cents. And that again is after paying off that 61 cents of downside protection. Same story. I was a little skeptical that this China trade deal was going to be signed. wanted to see confirmations from both sides, wanted to see some agricultural purchases. And more importantly, I wanted to see China trying to stimulate its economy rather than allow it to slow down. And we are seeing all of those, which remains a reason to be bullish on stocks. Okay, guys, let's take a look at this TLT trade so we understand what the heck is going on here. If we were to look at the open profit loss on this position, it's a little scarier than it might be come next week because a couple reasons. Number one, if we are assigned and the call option buyer exercises his right, which he very well may do because he's up maybe 50% on this call option. So if he assigns that today, come Monday, what would happen? Well, right now, to close out the position, which we do not want to do today, if you're listening and have this position open, right now your net open profit would show $1.32 or a loss of $5,016. And this is from the TLT going from 137.13 up to 138.57. We collected 17 cents on our inverted option caller. And currently to close that out, we'd have to pay $2.93. So from that standpoint, it doesn't look so great. But if we are assigned, which is highly likely at this point, we're going to receive, and I'll go to the trade alert so we can look at this together. You can see the mid price was 250 and we sold the 135 strike. So if we combine that, we can see that we entered at 137.13 and we stand to earn from being exercised 137.50 per share. So that's the strike price plus the premium. So that profit on the long side of the trade is actually 37-cent profit if we are assigned and exercised. Now, what will happen? We'll be in cash on Monday, but we'll still be long the put option that we originally paid $1.54. Now, currently at 138.57, that put option is worth 81 cents. But we got a few things going in our favor. So if you net this out, we're down 73 cents on the put. If we are exercised, we come out ahead 37 cents on the TLT. And that's a net loss come Monday, assuming the put option has the same value of 36 cents or only $1,368. So again, that's less than we're up on the emerging markets position. It's less than a third we're up on GDX, and it's very similar to what we're up on SPY. So our portfolio is performing just fine. But here's what could potentially happen. We know the big pressure is for yields to rise. So unless Iran does start to retaliate next week, which I don't think they will in this short of a time period, most likely those yields will continue to drop as that's the greater force. And that put option is going to slowly turn into a higher and higher value into next week. And in fact, if it goes below 137.13, that put option will most likely be in the money and be delivering us actually a profit next week. So we look at the increased implied volatility plus the profit we can get from being assigned. And this trade can turn out just fine come next week. So let's make sure we all understand that. Are there any questions on that TLT trade, how that can work out for us in terms of what we call the double payday? So my note is, thank you, Iran. This is exactly what we want to happen on an inverted option caller. It's the best potential outcome because we don't have to realize the loss on the TLT. We generate a profit on the first half of the trade right after issuing it, and then let the larger force do its work to appreciate the value of that put. Now, come next Monday, I will have the 2020 P&L started. So we'll get that January profit loss updated, but 2019 closed out very nicely with a 15% return, just slightly over our 12% annual target goal. Okay, so let's take a quick break and see if we have any questions. Are there any questions out there? Does this make sense to everyone? I'm gonna go ahead and unmute everyone so that you can ask questions if you have any. I saw you just joined in, Murray. Did you get the explanation on the TLT? Or did you catch that on the intro? Okay, great. Well, let's go ahead and continue. So to review, our stance remains exactly the same. As long as they're growing the balance sheet and not cutting rates, this is a classic setup for stocks to rise and at the same time for the value of bonds to go down or for yields to go up. And so until the Fed stops this trend, most likely this will continue. Now, what's fueling the Fed to expand its balance sheet? The US government's deficit. So the big question, and really something we want to start focusing on in the near future, is how much of the Treasury auctions are being purchased by foreign investors versus primary dealers, because it's really the primary dealers who are putting the pressure on the Fed to expand their balance sheet. And most likely, as these yields rise, we can expect that more and more foreign investment will be picking up the tab on US government, which will obviously slow down the growth of the balance sheet and also slow down the rise of the S&P 500. So let's reiterate what we've looked at quite a few times. If we go back to 2018, here's what happened when stocks rose, but we also had a Fed that was slowly raising interest rates. And so we can see what happened into 2018 was the yield curve slowly rose until it got to really the danger zone for stocks. And if we have inflation that can barely poke its head above 2% and a guaranteed rate of return of 3% on a 10-year yield, again, this is what the banks know a couple things. Number one, that's a guaranteed profit with no risk. So they love to purchase treasuries with such a healthy buffer. So that's number one. Number two, they know that everyone wants to get a guaranteed return. So this is detrimental to stocks. So if that's the case, they can anticipate they can purchase this 10-year treasury with a high yield, have a guaranteed profit in the bag for 10 years, and have the expectation that if this high yield does cause turmoil in the stock market, that the Fed will be forced to cut interest rates. And so what happens next? Well, let's look. I think we all knew what happened for the rest of the year. Stocks had a massive crash. And we can see what happened. Stocks crashed, yields went down. And by 2019, the Fed did its pivot in February and commenced into 3 rate cuts. So let's look at 2019 so we can see how that shaped up. And so the banks nailed it. They bought those treasuries at the 3% yield on the 10-year. And guess what happened? They were able to sell those for a massive profit. Now, right now, the Fed's only buying the debt in the 1 month, 3 month, and 1 year T-bills. They're not buying the notes or the bonds. Let's look at what happened for the rest of the year. Let me pull off some of these. And so we can see what happened. This 10-year, 7-year, and 5-year treasury, which was hyped up as a buy from none other than Stanley Druckenmiller last December, pitched this to everyone, and the whole world loaded up on that trade. Yields fell. The Fed cut rates. And once again, people bought these bonds made out like bandits. Now we're in the exact opposite situation. They're no longer cutting rates, and now the Fed is purchasing the front end of the yield curve. So we're seeing that these longer term rates are beginning to float. And despite some noise from attacks in Iran and things of that nature, there's not a huge fear in the market that something can go wrong. And so my expectation is that these yields will continue to rise into 2020 until we repeat what happened. So if this is the case, my expectation is for us to catch the bulk of the move. Let me pull up a chart on the SPY. So if this is the case, my expectation is that we will catch the bulk of the upside move in the first 2 quarters in 2020, and then the growth will substantially slow down as yields rise. And so what happens as the yields rise is that more and more foreign investment will be attracted to buy and hold those long-term treasuries as the yield will be appropriately priced, and this will slowly take pressure off of our primary dealers, that's your JP Morgan, and in turn take some pressure off of the Fed. So we can expect that their balance sheet growth will dramatically slow down as the yields become more and more attractive to buy and hold investors, especially foreign investors. So my current target is somewhere around, now it's really more based on when those yields get attractive and I start seeing the treasury auctions get a bigger and bigger bid from foreign investors, as well as tracking the growth of the balance sheet. So those are really what I'm focusing on in terms of calling a top on the SPY. But just to be realistic, I think a 10 to 15% move in equities is realistic before we hit this point where the yield becomes so attractive that it takes the growth of the SPY to a halt. At that point, we could probably expect a sharp reversal. Now, maybe it'll take all the way to Q3 or Q4 to reach that level, but that's something we have to watch. But if we're right, and there's between a 10 and 20% rise from this macro force, that puts you well above 360 in the first half of 220. So that's how I'm calculating that prediction. If we go look at the TLT, we can see that when it does have a reversal, it drops like a rock. So that's my expectation. The faster the TLT drops like a rock, the more force and money that will be flowing into equities. So that's exactly what I think will happen. And once it gets to this 120 level, I do think that'll be near the rock bottom for rates, or rather for how high rates can rise before the Fed has to intervene. So we'll see just how long this takes to play out, but I wouldn't be surprised if we're seeing 120 TLT somewhere by Q3. Now, meanwhile, we can go take a look at gold, performing beautifully. And again, this is all from Fed's balance sheet increasing. Last time they did this was in 2009, the very end of 2008, and you can see GDX just went up like a rocket ship. And that was just to cover up a relatively small misallocation of capital in US housing. This time around, the problem is much worse, and it's really from China's growth slowing down. So to paper up that mess will cost a lot more money, and we're seeing QE happening worldwide, not just in the States. So our target for GDX remains very bullish. Now, again, I think 2020 is where we get the rate cuts to begin. They may slow that out to last up to 12 months, perhaps. So if we started cutting rates towards the end of 2020 and then go into full-blown QE by middle to late 2021, this gives us really around a 3 to 4 year launch pad for gold. So we probably will have some volatility and decent growth in 2020, but I think we'll start to see the real fireworks when we begin to go into 2021 and 2022. And again, this is all expecting that China's growth will continue to slow down, that we will have to continue cutting rates, to fund governments and a lot of fiscal spending to try to stimulate these different economies, which we're seeing in Japan, China, Europe, and the US. So really, I just don't see any escape from this path, not unless the Fed decides to weaponize the dollar in some sort of attack against China, which would most likely end up meaning hiking interest rates. If they hike interest rates, we're going to see a recession. We're going to see negative GDP prints. We're going to have a whole lot of mess. So I don't think they'll do that unless it's their absolutely last option, which most likely be caused from inflation. But we're living in a world where low interest rates fuels companies that create products ultra cheap. They don't try to create a profit. They try to create market share. And in doing so, create these massive companies that are creating losses instead of profits and are subsidized through the bond market. If we look at emerging markets, this is critical to our entire thesis for 2020. We need to see emerging markets recovering. Otherwise, we could have a repeat of what happened in 2017. We saw emerging markets doing great, and then 2018 was a total disaster. So we're keeping a close eye on emerging markets, not only because it can outperform the SPY, but also because it's critical to our forecasting of the S&P 500 as well as the bond market. If the emerging market starts to crash, we're not going to want to bet down on the TLT. And we're going to want to get ultra precautious and defensive on our upward bets on the SPY. So even though the SPY rallied in 2018, it did not close out the year that way. Finally, this chart remains critical. LQD is what fuels the corporate buybacks in the top companies in the SPY. Until this cracks, they will continue to borrow for ultra cheap and buy back their own stocks. In fact, Microsoft was getting negative yielding bonds in Europe. So they're getting paid to borrow money in Europe to buy back their own stock. So when you look at Microsoft's chart, it's no wonder it goes straight up. If you could get paid a profit to buy your own stock, would you do it? Probably. Even the junk bond debt has the same pattern. Now, it's not as bullish as the investment grade, but you can see it's still getting near the low yields they saw in 2017. It's not as cheap as 2013 or 2014, but it's certainly not in a downward path. So we're seeing no signs of the credit markets cracking for US corporations to borrow money and buy back their own stocks. So whether you like it or not, that is the world we're living in. And those are our predictions going into early 2020. Now, I do have a much more elaborate presentation in the works for our daily content coming up next week. So today's presentation is a little short as I do get all the platforms designed, programmed, and ready for our daily presentation. And what you're going to see is our presentation will vary from day to day, so it's not quite the same set of content and research each day. So on Monday, Wednesday, Friday, we'll have a specialized presentation that's going to really zone in on the key trading partners for the US. We're going to keep track of what those central banks are doing with their balance sheets. We're going to make sure those key trading partners are creating fiscal deficits, just like the US is, which will force them to continue expanding their balance sheets. We're going to keep track of what our key trading partners are doing with interest rate policy, and also keep a track of their stock markets. So that's what you could expect on Monday, Wednesday, Friday. Tuesday will be very similar, but focused on the key trading partners to China. And then Thursday, we'll be paying close attention to the top 12 trading partners of both US, China, and Japan to keep track of what is the interest rate policy. So while Fed balance sheet is the best indicator for stock market, the interest rate policy is the best indicator for predicting changes in bond valuations. So it'll be a little bit different, more advanced, and really zoomed in great detail for each of these different trade alerts. And that way your daily presentation will be very exciting and new each day. All right, guys, any questions out there? All right, guys. Well, happy Friday to everyone. Quiet crowd today, but thank you for joining us live.
Hey, I have a microphone.
Oh, there we go. Hey, Karen.
It wasn't here before. Actually, I got two questions. One's
Excellent.
a question. Yeah, one's a question, one's a comment. I just started thinking about this. This is not affecting me right now, but you know, as I continue to expand my holdings in different accounts using your system, it just occurred to me going back to your TLT inverse scenario. Okay. I understand the concept, but I'm just thinking it through a little bit. And if that should happen and it gets exercised and then then we have to buy it back again, you know, the next go around when, you know,
You'll buy it back on Thursday. So you'll wait till
right.
Thursday. Yeah.
Right. But like, for instance, I just happen to be looking at my account. In my particular situation, you know, I had purchased it higher than it is right now. If it gets called away, I have a loss on the TLT. I buy it back less than 30 days. I got a wash rule problem.
You got a what? What's the problem?
A wash rule, right? If you buy it, right? Don't you have a wash rule problem if you buy back if you have a trade that closes, that's a loss? Is that, am I remembering this right? I mean, obviously not in an IRA, but in a taxable account. And then you buy it back again within 30 days. Isn't there a wash rule problem on that?
I think that's more related to trying to offset a profit on another trade. I'll look into that for you, but
okay, I may be getting it in reverse. I have to look it up again. I'm thinking, wait a minute.
Yeah, no, so you're just getting assigned. So it's as if you're selling your TLT on Monday. Yeah, you should have a profit. Well, it depends on what was
when you went into the trade. That's the whole point. Because when I originally got into this program, I mean, you know, I'm talking theoretically, just so I can think the whole, you know, your whole thesis through for an alternate account when I'm in a taxable account. I'm like, oh, wait a minute. And of course, I'm sitting here trying to review taxable stuff because it is a new year, let's face it. I was just going through some of this and I thought, I think there's an issue there and I just have to review that. It may have to stay on the sidelines for 30 days not to have that problem. It may not be that big of a problem depending on the loss, but I don't know, I have to look at that. Anyway, that was one question I had. We don't have to have the answer now, but it's something to think about. I may have to go look it up myself. That's one. The other thing is regarding what just happened over in Iran. I don't think all the pieces have fallen into, you know, I don't think all the players have vocalized or done or whatever. My concern is, you know, China, the trade deal, you know, China gets a lot of their oil from Iran. If they're pissed, I just wonder if the trade deal is going to get signed on the 15th. Just something to think about.
Yeah, certainly. So yeah, if the trade deal goes haywire, if China's not increasing its debt, yeah. So the way China takes on debt's a little different than the U.S. The U.S. issues bonds and goes out and sells it and has a nice, healthy foreign market who purchases their debt. China doesn't have that luxury. So China just simply prints more yuan. And so it's looking like they will probably print 10% of the total circulation and try to get 6% growth into 2020.
But I'm speaking about the trade deal that's supposed to get signed on the 15th of January for phase one, whatever they want to call it. That they don't seem to call it that, but do you think they might use that as a,
No,
that might,
I don't. I've seen
you know,
absolutely zero indication that China wants to escalate the trade war. Unfortunately, I've been dying for the trade war to escalate. Uh,
yeah.
so yeah, I see absolutely zero, not even a shred of evidence that they intend to. So here's the key things on that. Number one, they've been rolling back tariffs to allow their different companies to buy imports. Number two, and they know this better than anyone, that food inflation creates social unrest, and that's really their key problem. So they have a lot of food inflation. So I think they're just from that regard, from those two key points, is that they're rolling back tariffs to allow agricultural purchases, soybean purchases are skyrocketing. All their commentary is peaceful and saying, hey, I think we all learned a hard lesson. Let's try to do better now. So I just don't see any benefit to China. It doesn't look like there's any other political leader on the Democratic side that could win the election that would be pro-China. So I just don't see it. I see not a shred of evidence that China wants to create more. I think they have more problems than they can deal with right now. So we'll see.
And we just complicated it with Iran. I'm just saying. I mean, that's just
a little bit. A little bit.
Yeah, well, yeah.
So yeah, certainly if I see but look at the stock market. Stock market's already telling you what's going to happen.
Yeah.
We're already up $2 in 3 hours.
Yeah, it's really something. It's been an interesting day.
Yeah. So yeah, I mean, that's probably the hardest part about this job, is trying to filter what's just noise and what's a real paradigm shift.
Yeah.
And so, the phase one trade deal was a real paradigm shift to the markets. We went from a real risk of disrupting trade routes and turning the entire globe into a recession overnight with that trade deal. And I was waiting for confirmation, and we've seen a lot of confirmation. So we've got China purchasing agricultural products, lowering tariffs, putting out nice comments, and sending over a team to sign the trade deal. So if that continues, the next thing we need to worry about is China going to slow down? Are they going to allow their economy? They can really control what GDP they print, as their only thing that holds them back really is inflation. So if they start to see too much inflation, they're going to have to get a little more careful about allowing too much credit and printing too much money. But so far, once again, market's telling us that they're playing nicely, and we can see that with their stock chart just screaming up in December. So right now, the coast looks clear.
I think what's shocking to me as well is I always look at the VIX. They're just not freaked out. I mean, it's crazy, really, that it's not flying off the charts with all this stuff going on. It's amazing to me.
Yeah, it pretty much tells you it's a non-factor, Karen.
I know, and yet, well, we'll see. I know. You would think.
And Karen, I just sent you some links,
Okay.
one to the SEC and one to the IRS for the wash sale rule.
Cool.
My general interpretation is you just can't write it off as a loss at the tax year. Yeah, but you're totally okay to buy it back.
Okay, thank you. I appreciate those links. Yep, thank you.
My pleasure, Karen.
Very good questions. Good point. I'm certainly, you guys know me. If I think there's a risk, I'm more than happy to play it defensive. But at this point, the stock market's telling you this is just headline noise. Now, if they retaliate, China, they're just too small. Iran's just really just too small now. North Korea is threatening nuclear weapons. Iran is always threatening something or another. But I think if China were to get aggressive, that's really something to focus on. Outside of that, that's really, those are really the two biggest risks. From my standpoint, at this point, the key thing to focus on into early 2020 are the H4.1 releases. We get them every Thursday at 2:30, and then understanding what's causing this balance sheet growth. So the underlying cause is a massive $2.55 trillion budget for 2020. That's just insane. And we're short by at least $1 trillion. Throw in a few natural disasters, you know, you can add another $300-400 billion into the budget 2020. So we know there's going to be ample supply of debt that the primary dealers have to purchase. So the bigger question is, when do foreign investors start taking up the tab? So we'll be watching every treasury auction like a hawk to see when are the foreign investors going to start. You know, back in the penny stock days, it's funny listening to how these people would talk about trying to buy investor relation advertisements for their various little OTC stocks. And there's really two different groups of people you could attract. And they all wanted only one. All the people with a small company trying to build stockholders and awareness for their company, they all wanted one thing. They wanted buy and hold investors. What they did not want were what I call frog hoppers. Somebody's jumping from one opportunity to the next. So what the US government really needs are buy and hold investors in our treasuries at a decent yield, not one that's so expensive that we can't afford to service the debt. But what we don't want are people buying our bonds just because they think they can flip them for a profit. And so at some point, these yields are going to get attractive and start accumulating serious buy and hold investors into US debt. And that's what we desperately need to fund this massive deficit. So the question is, what is the magic yield that's going to take a lot of pressure off the primary dealers, take pressure off of the Fed, and slow down this balance sheet growth? So I think our best indicator for the stock market, again, is to keep close attention to those right now. Sure, in the back of my mind, if you've noticed, I'm not leading with the Chinese news right now because it's no longer the headline risk. The headline risk at this point is that it's funny enough, the biggest risk to the stock market is when the yield on treasuries gets so attractive that it gets the job done and sells it to foreign investors who are ready to buy and hold that through the duration. So if we keep track of the balance sheet growth and the percentage of each auction sold to foreign investment, that's going to be our best indicator when stocks are going to run out of this rocket fuel that's pushing it up right now. And so it's totally, it's totally crazy to think we live in a world where everything's upside down and backwards with this Keynesian strategy to stimulate the economy by just printing money when things slow down. But that's the economic model that all these large economies run on. And so a big problem with too much debt is giving us a bullish stock market. In fact, in our boot camp, I have a really good Peter Schiff episode. I'd say it's his best episode yet. Now, disclaimer, he's always going to come out with the conclusion that gold's going up, stocks and bonds are crashing, and that's that. But his analysis of how we ended up with this rocket stock market is great. And, you think about it, we have record debt and we did a fake trade war that goosed the Fed into lowering interest rates and going into QE and end up with a positive outcome in stocks. So it's comical to say the least. But yeah, now the big headline risk for me is to track the yield, foreign investment, and a slowdown in the growth of the balance sheet. In fact, people have been actually pointing out that this one single week where the Fed's balance sheet dropped is the only week we had a significant sell-off in US stocks in the past 3 months. So it's extremely correlated. And luckily enough, it's relatively easy for us to follow. So this sort of analysis is what I'm going to do, not only for the US, but also for its key trading partners on Monday, Wednesday, Friday. So that's primarily Mexico and Canada. But we'll also be looking at some sort of canary in the coal mines like South Korea. Then on Tuesday, we'll be looking at China's key trading partners. So we'll be looking at Japan and a host of other countries that they do business with, like Australia, Vietnam. By focusing on that right now, I think we're going to get the best outcome. In terms of geopolitical risk, I think that Trump is going to be tempered in 2020 because of the election. Now, that is an assumption, but I think that is one we have to make until he's done something that is absolutely not in course with that judgment. So that's what I was telling you guys all year. Hey, if Trump is going to escalate the trade war, he's got to do it. He's got to do it soon. Otherwise, he risks putting the economy in a recession in his election year. And sure enough, he didn't do it because he knew it'd probably put us into a recession this year. So I was wrong, but we played it safe. And now the coast, to me, is much more clear, and we can focus on a different headline risk. Let's see, Murray, you got your microphone? I always like to hear what Murray's thinking. I unmuted you, Murray. If you have your mic, we'd love to hear from you, bud. Anyone else want to say any comments, questions? Boy, that SPY is just cranking up. So let's see how much we're up on this trade so far. So I entered at 322.63 for a debit of about 40 cents. Let's see what exactly. $0.46 entry. What price did you guys pay for your options? Anyone out there? Let's see where it's at right now. Okay, well, so Mark, this is one of those nice opportunities to not worry about it because your other trade has a greater profit than mine does. So you'll still not miss out on the gains because of that long call option you have. Let's just see how much this current trade is up just an hour after issuing it, just for fun. Okay, so we're up almost $1 on the underlying, and could get out of the option for 60 cents. So we're up about 40 cents a share in an hour. That is incredible. Typically, we're trying to make 25 to 50 cents after the entire trading period, not just within a few hours. Oh, actually, let's see. We're up more than that. Let me. If we were to close this out. Okay, so current trade, we entered at 322.66. It's almost at 323.58. So we're shy 90-cent profit on the underlying. We had to give back 46 cents, but we get 22 back. So that nets out about 70-cent profit per share in the first hour of entering the trade. Not too shabby. All right, guys. Well, thank you so much. Quiet crowd today. This was, I think everyone in here is customers. Most of our free trials did expire. So thank you for joining us. If you have any questions. We do have an update on the boot camp coming out. Those positions are doing very well. No change. And Saturday, I have some good content coming out for you. 6 videos, one of which is Peter Schiff keep in mind, I don't agree with all of his trade recommendations, but I do love his critique and analysis. I love listening to his kind of sourpuss attitude all the time. It's comical, but it's dead on. It does explain what happened in 2019 very well. And I do like at least his prediction on gold. So from that point of view, it's a great listen. We have a farmer of all things. This guy lives out on a ranch. He's got a huge following on YouTube. He's a great speaker, very, very thoughtful. Really has a good sense of commodities, but he put together a great video on the repo, and he does seem to listen to a lot of the same people I listen to. So you got that. He's got 2 or 3 videos included from his YouTube channel. We've got another piece on the derivatives relative to Deutsche Bank, HSBC, and SoftBank. And that's just mind-blowing. Once you really understand what these bankers do and insurance companies do on a small loan. So you give a small loan out to some small company, and then hedge funds come in and start speculating on that loan and take something that's maybe of a value of 10 million and turn it into something that's in close to the value of 100 million, and then start using that as collateral to buy stocks. And all of a sudden you can realize just how leveraged the system really is. And it's massively leveraged. That's why we got to have our puts below these. Even though I'm thinking stocks were going to fly for first half of the year, I would never have you guys long stocks without a put. If anything went wrong, that is going to save the day. So that's the bulk of the content coming out. Also, a video from Polymatter, which he has the best visuals, shorter videos, but he talks about food inflation. So you got to be asking yourself, what's going to stop this maniac stock market, this low yielding corporate debt scheme? We all know it's ludicrous, doesn't make any sense, but what's going to stop it? Probably inflation at some point. That's probably the only thing that will stop it. So that's starting to show up in food prices right now. So that's definitely something we want to be closely observing as well. But at the same time, the Fed is telling us they're going to let inflation run hot. So if we see inflation running hot, I think we'll see the TLT crash really hard. But the Fed may not do what it should do and hike interest rates. They'll probably give us a little bit better heads up from their FOMC minutes. So it'll be another key item to study in 2020. Okay, well, that's a wrap. Thank you so much. Our presentations will expand next week and take advantage of some new platforms and more in-depth analysis. So thank you so much for joining us live. And again, no action on your bootcamp trades. I will send out an update overviewing our schedule, as well as how much we're up on those 4 stock positions we just entered. You'll have a Saturday with 6 videos to study into next week. And the next Q&A is Monday for our bootcamp members. So thank you so much and have a great weekend.
Thanks, guys. Take care.
Thanks.
Thanks, guys. Have a great
Thanks.
weekend.
Thanks,
Happy New Year.
Karen. Happy New Year's, everybody.